Hey guys, how you doing? It's Will Caban. Something a little bit different about me today. Much better. The question that I get asked a lot lately is, are we in a housing bubble? Now, I'm not surprised that we get this question because in a market where prices have been going up, competitive offers have been skyrocketing, the general consensus is there's a concern, right? You're concerned about buying a house that's going to be at the top of a quote-unquote housing bubble. But before I get into any of that and we get into facts of 2006 and we get into the facts of 2021, just want to give a little bit of background information on myself. I wasn't a loan officer back in 2006, but I did work in the financial services industry. I've been in the financial services industry pretty much my entire life, or at least my entire working career, not my entire life. That would be wrong. I happen to be working in New York City, right in the thick of it all. As a banker, you got to see firsthand how it affected people's lives. It affected a lot of people's lives forever. And a lot of the first-time homebuyers that I work with now were children of that generation. The media has been talking largely in the last couple of years about us being in a housing bubble, only to continue to see prices being well supported. Majority of people who buy homes do so based on monthly payment, right? It's the most responsible thing to do. It makes absolute sense. But we have to consider the differences in mortgage interest rates as well as the differences in household income between 2006 and 2021. That's going to tell the full story and give you full context of where we are now versus where we are then. When we look at the interest rate market, we break it down there. 2006, interest rates are about 3% higher than they are now. When you look at income levels, and this is all based on statistics from the BLS, income on an hourly basis is up about 55%. And housing is roughly 41% more expensive. So when breaking down these numbers, which I'll do in a minute.
What you guys are looking at over here is purchase price in 2006 at $300,000 with a 41% appreciation. That same $300,000 property would be $423,000 in today's market. At 5% down, you'd be looking at $285,000 loan amount in 2006 versus a $401,000, let's call it $402,000 loan amount at 5% down. Now, you see the interest rate at 6% versus 3.125. Very realistic numbers. And then when we look at the monthly payment, we're looking at $1,803.72 versus $1,821.89. Now, it is more expensive by a factor of $18.17. But when you start looking at some of the other numbers, right, the longer term and shorter term numbers, is where it gets really interesting in terms of the overall savings in 2021. So we look at the savings over a 60-month period, which is 5 years, and you start to see that, things start looking a little bit better. $23,000 appreciation in terms of the savings is a pretty big deal, right? But it doesn't stop there. When we look at the interest and the mortgage insurance paid over a 15-year period, in 2006, you would have paid $242,000 in interest and mortgage insurance, whereas in 2021, you would be paying roughly $173,000. So that's a pretty wild difference. And that's, again, only at 15 years. If we did this at a full 30 years, you would see a larger variance between what you actually paid in interest and mortgage insurance. And I think when we break that down and you look at it from that context, there's a big story here that most people don't get. And I use this analysis on, a lot of presentations when clients ask me, is it a good time to buy or isn't? And I just kind of let the numbers kind of, speak for themselves, because I think it's important to have that reflect. So this is what the scenarios look like from 2006 to 2021. Let me know what you think.
Do not let media scare you out of all the benefits of home ownership. I do want to go over some of the ways to make sure that you're making a responsible decision when you're purchasing a home in a market where housing prices are increasing. We all need to have some sort of shelter, whether we own it, whether we're paying a mortgage, whether we don't own it and we're paying a landlord. In some cases, in rare instances, we might have the ability to live with family and live with relatives and not have to pay any rent and not have to pay a mortgage. But for the most part, individuals have to pay a housing expense. So the difference is, do you pay yourself or do you continue to rent? And that's a big conundrum amongst new home buyers right now is, do we want to own? Do we want to, rent and see how the housing market's going to look when it slows down a little bit? But here's the thing, is it really going to slow down? And how much is it going to slow down? Those are the things that we need to be cognizant of. Just because I can qualify you, just because your loan officer can qualify you for X number of dollars all the way up here, doesn't necessarily mean that you should go out and find a property that is, at that price range. So being responsible when it comes to creating that budget is extremely important. All right, so here are some ways to make sure that you're making a responsible decision when you're buying a home in a housing market with increasing values. The first, and this is my number one rule, is that you always have to buy within means and a budget that you're comfortable with. Now, what I mean is, if you have to create a budget based on being a family of 5, because you have to go out and you have to find a property, whether it's a rental, whether it's a house, that needs to accommodate, say, 3 or 4 bedrooms, you got to ask yourself and do some market research and say, what is this going to cost me in a rental market? Right now, the rental market is almost just as crazy, if not even crazier, than the housing market is. So you have to take this in consideration and be realistic about what your scenario is and see what that number is going to look like. If it's going to cost you $2,500 a month to find that property in a rental, what does $2,500 a month translate to in purchasing power? And a good loan officer and a good real estate agent would be able to give you a good range of what that's going to look like. And then from that range, you can discern, can I purchase right now with where prices are? Am I going to find what I'm going to be able to accommodate my lifestyle? Or do I need to just kind of look at renting for a while and wait to save up a little bit more money, or wait to see if, home prices do tie down a little bit and then jump back into the market? That's one of the key things that I think is always important, is creating a budget with what the market is giving you. But then the other thing too is, we need to also be realistic about if you can afford and qualify for, say, $5,000 monthly payment. It doesn't necessarily mean that you should go up that high, right? You want to stay fiscally responsible. You want to stay conservative. That's the way that people got through the first housing bubble. They kept monthly payments that were close to what they were comfortable with. And that allowed them to not necessarily be affected when housing prices started to come down at the rapid pace that they did, because they were in a position to comfortably pay their monthly payments, and it didn't affect their lifestyle. The second is, I would look at, doing a multifamily property. FHA right now, at the time of this recording, which is September 6, 2021, it allows you to do 3.5% for multifamily properties. The reason why that's advantageous is because they would take the income from the second, third, or fourth unit, and they'd be able to put it into the income for the property, and you would be able to offset that. And maybe, a year, 2 years, 3 years later, when you're ready to buy another property, you would be able to have that as a fully functioning investment property. You should view your property as an investment, and this is a really key thing, and you need to manage risk appropriately. The most obvious example is, most people in some sort of facet, they'll save for retirement. Whether it's a 401k, it's a SEP IRA, it's a Roth IRA, or something along those lines, annuity, insurance, etc. These investments usually consist of a well-balanced stock portfolio. Some position of it will have some stocks, and some positions will be bonds, and they'll have some REITs and real estate investments and things like that. Now, we all understand the level of risk that's associated with that, right? Because we invested it pretty much on a consistent basis, whether it's bi-weekly, weekly, annually, quarterly, etc. We do that on a consistent basis. Now, there's a tremendous amount of research that shows, if you take a small portion of a larger portion of assets and you invest in it on a dollar cost average basis, you're going to fare better over a long period of time than you would if you just take a lump sum and put it into that one investment. It's the power of dollar cost averaging. It's like the basis of financial responsibility, investing, etc. It would be unwise for you to throw all your money into the market at once. And what I mean by that is, when you're purchasing a home, instead of looking at the money or the assets, you have to look at your purchasing power. So if you have the ability to qualify for $5,000, why not try to make it a game and go find something that's $25,000 or $3,000. Purchasing power is simply your ability to be able to afford a home based on your debt to income ratio. So why do we want to max out your debt to income ratio? A home, especially from a first time home buyer standpoint, It doesn't necessarily need to be your forever home. In most cases, it's not going to be your forever home. I suggest if you can qualify for X number, let's go for the more conservative route, because that route is going to give you the option to be in a position where you can actually, afford something or be better prepared if something were to happen, right? And this is not just relative to a housing bubble. This is relative to just life. If you happen to lose your job, if you happen to get sick, if you happen to get disabled, just anything in general. I mean, it's just being fiscally responsible. There's that aspect of it, which is the debt to income ratio. But then there's also the aspect of assets. Most people, when they think of down payment, there's either a few different schools of thought on this, and most people think that putting 20% down is better. With respect to that, I'm more focused on having better credit and having a high credit score than I am with having 20% to put down. Because if you have 20% to put down, but you have a lower credit score, your rate's going to be higher, your out-of-pocket's going to be higher net than it is if you have, say, 15% down with the top tier credit score. And I can show you that all day because I do it all day. And then what you do with that additional capital that you don't put into a property, instead what you can do is you can earmark that money, say 5 or 10% of that 20%, and put it into future investments, have it on the sidelines for emergencies, any needs that you have, or just peace of mind, right? Just peace of mind. Peace of mind is invaluable. And in essence, it's always easier to spend money than it is to save money. So if you're in a market where you're concerned about housing prices, if you're in a market where you're concerned about monthly payments, if you're in a housing market where you're just overall ebbing towards being conservative, don't shy away from putting less into a property and keeping more on the sidelines in the event that you needed more. So with all this being said, I just wanted to thank you guys for watching this. I know it was a long video. If ever you have any questions about anything, feel free to reach out to me. Will Caban, take care.